In this video, traders, we're going to look at trading earnings gaps. Stay tuned. Hey guys, warm welcome to you. Alright, so when earnings season comes around, specifically if you're trading US stocks, you get a plethora of opportunity as a day trader and a swing trader, just purely because if you think about what earnings does, it can reprice or revalue that asset. And it's really like a strange scenario because yes, price will kind of move, ebb and flow, up and down, supply demand will shift, and you'll get big moves in price based on people's theory of what the stock is going to do, what the company is going to do, the value, etc. But earnings really is a point in time where everyone comes in sync and says, oh wow, they're doing much better than we expected, or oh, they're not doing as well as we expected. And then people can vote based on that new form of information. It's almost like a checkpoint. If you're playing a video game, get to a checkpoint, it's like, right, here's a new information point, and now people are basing their decision from that. So it's a really good kind of perspective from a trader's perspective, because everyone sees that information, everyone knows what's happened there, and they're making the decision based on that, not based on guesswork. So very often we get repriced scenarios. Repriced scenarios basically means that the valuation is distinctly different. Well, the majority of people, traders, investors, believe the valuation is distinctly different. Either it's the upside or downside. And that causes, obviously, price moves. So if we look at this scenario here, we've got a market chugging on, then we have the earnings coming out, and we get this huge gap up on earnings. Earnings normally come out after hours, sometimes before market close, but before market open. But anyway, the point is, regular trading hours, when the stock opens, that will then represent the collective response and valuation. People believe the valuation of that company is at that point in time. Yes, there's some after hours move, yes, there's some activity there, but there's not that much volume. It depends on what stock you're trading, obviously, but when institutions are around, and obviously the options are only open during regular trading hours, so the big volume, big money starts to flow at the opening bell. And at the opening bell, you're thinking, okay, this is when the voting machine really is turned on. And so if you get a gap up, a big gap up, how are you going to trade it? Now, obviously, guys, if you're trading earnings, if there's no gap, you're probably going to look at it as a normal trading pattern. So there's no gap, but then you suddenly get a strong day. You might say, okay, well, there's some momentum there. Let me look for day 2 or day 3. But what about if you do get a gap? So the first thing you want to see is what's happening on day 1. Now, if you're a day trader, you're going to adjust this. You're going to look at things differently. You might be trading intraday patterns that are happening just purely on the volatility of the earnings day gap, because there's lots of volatility pushing to highs, double bottoms, momentum flags. There's opportunity there. But this is more about how you're positioning from a swing trader's perspective after you've had the gap. So the gap's pushing up. The first thing you want to do is look at the metrics of the gap. So the range of the day on day 1. So how far we've gone to the high, how far we've gone to the low, where is it relative to the open, where is it relative to the close, and what's the pattern of the day? Did we kind of push lower early on and really just rip up from then and close at highs? That's much different from if we kind of pushed the highs early and then went to lows and then retested highs. There's a slight difference there. So again, understanding and thinking about what supply demand means when you're kind of analysing day 1. So day 2, then you want to look and see, is there an additional gap on day 2? Have we pushed to new highs again? Are we continuing with that strength on the gap up? What's the opening hour like? How have we responded to the VWAP? And again, we'll probably look at VWAP on day 1 as well, the volume weighted average price intraday. If that's basically held and price hasn't come anywhere near it, if it has, it's held higher, you could assume that institutions are buying this. And then the volume as well. How is it looking relative to the first day 1? So you start to build a picture and you start to say, okay, this stock is strong from earnings, the fundamental strength is there, and people are believing the fundamental strength. It's had time to sell off and it hasn't. Now, bear in mind, guys, there's multiple ways of trading. This is just one idea of waiting for the couple of days. And the good thing about this is it's very easy to screen for. So if you're busy doing other stuff, rather than kind of having to look and focus on the first day of the gap and making a decision, you can go, right, second day after the gap or third day after the gap, I can now look to initiate a trade. So we're looking for continued strength, but then to also see continued strength, we then want to know where we're going to pull the trigger. Are we going to pull the trigger at highs, or going to pull the trigger at lows? Now my preference, again personal preference, is to see day 2 strong as well, okay, whatever strength that is, it might not be the same kind of strength, and then look for a pause or some small amount of weakness on the third day. and then look to initiate a trade in the direction of the move. So yes, if you're day trading or if you're a little bit more aggressive, you're probably going to be jumping on this day one by seeing intraday trade, looking for it to close at highs, looking for follow through for day 2, 3, fine. But if you're swing trading and you're kind of just being a little bit more cautious about things, at the end of the day, if you see a good strong gap up, strong day one, strong day two here, day three, what you really want to see, let's just kind of zoom in on the intraday chart, is some weakness. Now, I'm not talking about a complete slamming that kind of closes below the low of the gap. Stay clear of that. You don't want to get involved in it. But you want to see some congestion, some acceptance of price, some attempt to go lower. And because what you're trying to do is you're trying to see, let's see if you can get some acceptance, some kind of probe lower that tries. And then you see this, maybe you see a little bit of a tail that goes below the prior day's low, but doesn't hold, a little bit of a indecision. That then gives you a much better way to frame the trade, because the danger you've got, and it's not saying you can't do this under certain circumstances, but the danger you have when you're chasing stuff on day 1 or 2 is, where do you put your stop? The key thing we're trying to do with this day 3 or 3-day approach is to find a good level for a stop. Because otherwise we go, well, if you're buying it here, where do you put your stop? Do you put it under there? On day 2, you put it, and then of course your risk reward ratio is completely messed up, in which case the trade is almost just as useless. It's almost a useless trade, because you've got to have the risk reward ratio to make it work. It's not always going to work. So the reason you're waiting for day 3 is you're waiting to see some push against the gap like this. So you're getting this kind of scenario maybe where, it's pushed lower, and perhaps you do get a little bit of a tail. Perhaps you do get, wouldn't want it too low by the way, perhaps you do get a little bit of a tail. Maybe you do get a little bit of it, but you want to see something that shows some weakness that's been rejected. So you kind of got to stack your ducks in a row, so to speak. So the strength of the gap, the fundamental movement, the confirmation with price, the follow through with price, and then the slight pullback or the slight acceptance of price to give you your stop level. So you're saying, yes, I want to get long, I want to get long, I want to get long. I need to see it try to go lower at some point to give me a place to put my stop. And then you may well be buying a breakout of the high on day 4 even, but you need that stop position, which normally comes on day 3 or day 2 it can be. So then you go, right, there's my day 2, right, now day 4, maybe you're opening here, okay, I'm going to buy a breakout of this high, but I know I'm going to put my stop here, so my risk reward is very defined. And you're going with a couple of assumptions. You're going with one, I'm assuming the momentum is going to continue, and very often it will. You'll get that decent kind of move, and then you can look for a 1, 2, 3-day move from that. Number 2, I have a decent place to put my stop based on where price has been, rather than an arbitrary level. And that's fine with some setups, but this one you want to see that price a decent level, and that may well be on day 3, some kind of low put in, some kind of wick, some kind of tail, some kind of double bottom, whatever it may be. And then the trigger for that is going to be trigger for the long is going to be as we come off that. Maybe then you're taking a short-term breakout of that day 3 high on day 4, or maybe if it's breaking an afternoon breakout, you're taking that. But you're lining everything up. The danger that people, or the trap that people fall into, and I've been there myself, which is why I've come up with these different strategies to become better at really extracting profits from these moves, is that you see the momentum, you chase it, and you don't have a place for a stop. You have an arbitrary stop level, then you get stopped out, but then it's just like a little bit of noise, and it's very difficult to really have a consistently profitable strategy just by chasing stuff all the time. It can work, and in some markets it pays off time after time after time, but majority of the time it's not going to pay off. So waiting for that move lower, waiting for a support level to be put in or somewhere or another, and then coming off that within the broader picture means that okay, I've got a level to work off now. Now I can look for my trigger long. Now I know my stop's going to be. It becomes much better. And risk reward for these is something like 4 to 1, 5 to 1, 6 to 1, and more. And that's the beauty of it, because you don't know how far these are going to run. In the day, once it starts to be digested, shorts have cleared off, all this other stuff, and then you see the confirmation of that, then it just becomes a potentially very, very beautiful trade. And the good thing is, of course, is you can get stopped out of these. You've got good risk reward ratio and a good probability of success. You can get stopped out of these time and time again, knowing that one will undo. One big winner you can undo kind of 3 or 4 stop outs. That's the beauty of a strong risk reward ratio. So guys, that's the trading earnings gaps. Looking for the day 1, the day 2, often the day 3, but lining everything up, I think, in my opinion anyway, and also in my experience, this is better than chasing stuff blindly. And there's a lot of gappers out there. You know, you go to earnings season, you see these gapping to the upside and downside quite a lot. So well worth looking at. And again, this is, again, I'm just sharing stuff with you that hopefully helps. Not saying you definitely need to do this, but maybe you can take a few bits from it, tweak it, adjust it, and add it to your trading plan and just make some better trades. Take care, get your risk management, whatever you're doing. Bye-bye.